Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again and back on for another 360 Money Matters podcast.
Andrew, always back again and looking forward to bringing our viewers and our listeners a pretty interesting topic that we've spoken about in the past before, but it's probably a really interesting conversation that keeps popping up with our clients more and more so these days.
Yeah, absolutely. And it's something that we touched on in the last episode. So we figured that, hey, since we've touched on it, since we've, had a little, skirt around the edges, it's probably time to do another deeper dive back into a debt recycling strategy.
Debt recycling, that's exactly right. And the reason why it's been an interesting topic for us in terms of our conversations with clients is because, and we mentioned it during the last podcast, and I did say that the interest rate increase has been positive in one aspect, meaning that people are paying more attention to their debt. Whereas I guess in the recent past, you didn't need to do that as much because interest rates were so cheap. So servicing your debt and the amount of money that you could borrow wasn't as big of a consideration as it is today because it was easy to be able to service that debt. So naturally from those conversations, what we've been finding is that people are turning their attention to their mortgages in particular and then coming to us and saying, hey, how do we pay this off faster? So we thought that this is a really opportune time to retouch on debt recycling, what that is, how that helps people, do a bit of a dive into it, and try and get some information across because that's what we've been seeing recently. So maybe Andrew, over to you. Let's introduce, for those that haven't heard of the term before or don't really understand what it is, what's debt recycling?
Yeah, look, debt recycling is, and I'll talk sort of a little bit broadly around what it is before we actually run into the specifics. But in essence, it's a strategy that we utilize all of the time for clients. And what you're doing is you're converting your owner-occupied debt, so the property that you're living in that has an element of, or a mortgage against it, you're converting that debt from non-deductible, so you can't claim a tax deduction on the interest associated, into a deductible debt. So you're actually converting it over or being able to claim a tax deduction in essence on your owner-occupied mortgage, even though you're still living in the property. So that's, the broad crux of what it is, and you're utilizing that in order to be able to pay off your mortgage faster than what you otherwise would have.
Okay. I like the sounds of that.
Sounds exciting. I mean, that should hopefully get people a little bit excited around how you do it, what happens, and why it is. But that's the broad theory of exactly what we're trying to achieve in this strategy.
All right. So two key messages: debt recycling at its core is designed to pay off, let's call it your owner-occupied debt, but it's non-deductible debt, so your home loan. So it's designed to pay off your home loan faster, and at the same time, essentially convert. The way that you do that is by converting your non-deductible owner-occupied debt to deductible debt.
Correct.
Okay.
Correct.
Sounds great.
Sounds amazing. So how do you do it, Bills? Give us the keys to the kingdom.
Very good question. Before we get into that, we might just explain, just taking it a step back a little bit in terms of the deductibility around debt and how that plays in and why, from an investing perspective, and we've heard the terms good debt and bad debt and all of that sort of stuff. I don't really like those terms particularly because in the right circumstances or the wrong circumstances, all debt is bad, right? So essentially, let's just go back to basics here. Your owner-occupied debt, so your mortgage, you cannot use that to claim a tax deduction. Okay, so the debt that you've got, you incur the interest, you pay principal, you pay interest. You can't do anything with the interest that you're paying from a tax deductibility perspective. On the flip side of that, if you've got an investment property that you've got a tenant in there and you're paying interest on it, you can claim that interest that you've paid as tax deductible. So there is a tax advantage to having tax deductible debt. So if you look at the status of debt, theoretically, you want as much debt as you can that's tax deductible and as little as debt as non-tax deductible.
Correct.
So really at the core, what we're doing is over time, we're converting the non-deductible debt on your home loan. We're converting that to deductible debt. And for those that are watching on YouTube, basically with my hands, I'm moving one down and one up. So essentially you're taking debt from one asset and converting it across to the next.
Yeah.
So what that does is that over time, it increases the amount of taxation benefit that you get from the tax deductible debt.
Yeah, absolutely. Absolutely. And so, look, I guess the first question that most people ask is, how do you do it? Like, how do you just convert a debt from non-deductible to deductible? Is it legal? Am I allowed to do this? And so the first caveat is yes, of course. We wouldn't be making or we wouldn't be putting this out there if there was something that wasn't allowable by tax law. But in essence, what the ATO will look at when they're determining whether a debt is deductible or non-deductible is, has it been utilised for an investment purpose? And if it's been utilised for an investment purpose, then generally the debt is tax deductible. Mm-hmm. So what I mean by that, and why this is kind of an important distinction before we run into the specifics, is let's use the assumption that you have a property and it has zero debt associated with it, right? Now, you're living in the property. Mm-hmm. If you decide to take out equity, so you take out equity and you buy a $100,000 car or you use $100,000 in order to purchase a car, not for a business use or anything like that. Because it's against an owner-occupied property, technically that debt is non-deductible. If that property then becomes an investment property, it's actually technically not deductible. So if you move out of that property and move into another property, even though you still have a mortgage against it, the use of those funds was not for an investment purpose. Yeah. And so it's actually not a deductible debt if you're following to the letter of the law. So it's not actually necessarily the status of the property, whether it's an investment property or an owner-occupied property, but rather the use of those funds, what was it actually utilised for, that will determine the tax deductibility associated with it.
Yeah, and that's a really good determination because it's important as we sort of get into the mechanics and start to unpack how this strategy actually unfolds. It's important to be able to determine and distinguish the use of the funds. And the way that we do this when there's debt is you just take a split in particular. So you might have, your owner-occupier where you've got the main loan that you've got, which is your mortgage, and then in its simplest form, let's say you take out $100,000 worth of equity. You take that out as another facility that is split, so you can differentiate between your main deductible loan, your main non-deductible mortgage loan, and the new loan that you've taken out being the investment loan. Yeah. So, really, really critical point from that perspective. But in its simplest form, let's work through the mechanics about how this works. So I'm not necessarily going to talk numbers and how much equity and stuff because I think that'll just add too much confusion. But let's say you've got a whole heap of equity in your house. You've got the ability to borrow extra money. You've got the ability to be able to service, no dramas. You take out as a split $100,000. And in its simplest form, you take that $100,000 out and you go and invest it into, we'll call it the share market, and you go and buy a parcel of shares worth $100,000. When you service that debt being the $100,000, that debt now becomes tax deductible, right?
Because it was utilised for an investment purpose.
With the intention to be able to derive income.
Correct.
Now, the reason why I say that distinction is because the income that comes off that debt, the income that comes off that investment from the debt that you've used to purchase the shares, what do you do with it? So rather than like a traditional asset, if you use debt to purchase an asset, like an investment property, the rental income will go to servicing the loan. Yeah. In this instance, what you'll do is you'll take the income from the shares, being the dividends, and you will put that income into your owner-occupied debt, not into the debt of the $100,000 split.
Yeah.
Because you're using the income from that portfolio of shares to pay off your non-deductible debt. So theoretically, you're still paying your debt back and you're still paying it down, but you're using the income from the investment to be able to drive down your non-deductible debt. So over time, your non-deductible debt goes down faster than it ordinarily would have if you were doing this the other way.
Yeah. So let's maybe unpack that in some numbers and say, all right, in Billy's scenario, you might have had a mortgage of $200,000 on that property, and that $200,000 worth of debt is non-deductible. So what Billy's said is, okay, we're going to take out another $100,000 loan. Yep. So your total debt's going to go to $300,000. Yep. But that $100,000 extra, you're going to put towards really what you're looking for is a high dividend yielding investment. You want an investment that's going to provide an income. That investment of $100,000 is, or the debt associated with the additional equity release is tax deductible because it was used for an investment purpose. So you've got a tax deduction on the interest associated with $100,000. But then in addition to that, you're also utilizing the income from that $100,000 portfolio, let's say. Now, let's say it's deriving an income of 5% a year. That extra $5,000 a year in income, you're using that $5,000 not to pay out the $100,000 loan that you've taken extra, but to pay out the $200,000 loan that's non-deductible. So what you're in essence doing is reducing your owner-occupied mortgage, your bad debt that's non-deductible, and maintaining your investment mortgage, which is essentially good debt because you're claiming a tax deduction on it. So what you'd also want to do is you'd want your investment debt, so that extra $100,000, you want that to be on interest only because you don't actually want to pay down the debt. You want to keep that pretty much stable, and you want to direct all of your income that's coming from the investment, but also your cash flow that you're putting towards the mortgage, all of that to go towards paying down your owner-occupied debt.
Yeah, no, well said. And look, that's probably something that is misunderstood with this strategy in particular. Is any additional money that you've got, you want it to go into the non-deductible debt. And at the moment, and using those examples and using those numbers, it's only a small change. Yeah. At least initially. But over time, as things progress, that gets bigger and bigger and bigger. And there's different ways to sort of skin a cat in terms of the strategy. We were using, in this example, a lump sum of $100,000 and you do it once, but you could have a $100,000 facility and over time you could dollar cost average into the market, or every time you've got available equity and serviceability available, you could also borrow a lump sum and invest it from that perspective. But over time, I guess probably the thing to call out is that when you model this out and when you calculate this out, at the end of the day, when you've got your non-deductible owner-occupied debt paid off, you've still got investment debt. Yeah. So then what you do at that point in time, so you need to be comfortable with knowing that the time frame that you're going to have debt will still be not longer, it'll be shorter overall, but you're still going to have debt.
You're still increasing your overall debt position at the beginning of the strategy and throughout as well.
The debt that you've got converts across, and then once you get to a position that you've got your owner-occupier debt paid off, you can then make a decision to either sell down your portfolio to help expunge the debt, or what you could do is divert the income that's being derived from the asset or from the investment to be able to start paying back the principal associated with that. Yeah. All the while, along the way and throughout the years, you're getting the benefit of the tax deductibility associated with investment debt.
Yeah, exactly right. Exactly right. So you can, in the example that we've utilized here, we're talking about doing this strategy in one instance just purely for, simplicity's case. Yeah. But what you do when you're actually implementing a strategy like this, or what you'd very likely do, is as more equity, so as you pay down your owner-occupied debt and your debt position goes down in your owner-occupied debt, it frees up available equity to be able to take on more investment debt and continue to rinse and repeat this strategy, either in, a lump sum, or in what Billy's saying, which is having a facility that also allows for this exact strategy. And so I think that's also another thing to call out is there are products and lenders that specifically cater towards this type of strategy. They understand it and they know that, there's a mechanism to be able to do it. So it doesn't need to be as manual as, taking equity out every single time you want to, utilize the facility and needing to go through a refinance process and whatnot.
Yeah, and that's a good call out. And I think probably the next thing that we should pivot into is specifically who we see that this strategy is applicable for, because
it's not right for everyone.
It's definitely not right for everyone. But let's go through some of the key things that we tend to look for in terms of who this is relevant for and who it could potentially suit. Now, obviously there's some few key things in here which will sound quite obvious, but they're important to call out. But I'm probably going to start with, the famous one, and 40 Winks, if you're out there listening, we're looking for sponsorship, but we talk about the sleep test being if you're going down a particular course of action, and in this instance, it's taking on more debt and it's moving things around and the like, if it keeps you up at night and you can't sleep, it's got to pass the sleep test first and foremost.
Yeah.
So that's probably the first thing from my perspective. 40 Winks, shameless plug. If you feel uncomfortable with this, like if it's like, Billy or Andrew, you're proposing that I take on $100,000 of additional debt, I can't even think about that because, whatever, it's the wrong move. Right, so sleep test for me is probably the first thing. Jump that hurdle. What do we got next?
Look, the next thing is you obviously need to have equity in your property. Yep. If you don't have equity in your property and you're already, 80% LVR, then it's just not the right strategy for you because you're not in a position where you can actually utilize the equity in order to be able to, draw that out and invest the proceeds. So the other requirement in order to, be able to facilitate this strategy is having available equity in your property.
Yep. As an extension of that, having the ability to be able to service is also critical as well too. Now, you will be getting income off the investment, which will help contribute to the serviceability, but it goes beyond that because, the more money that you do borrow, you've got to make sure that you've got the means to be able to pay it back. So the ability to be able to service is also a critical factor in my mind as well too.
Yeah, so you need the cash flow requirement in order, to be able to do it. Yep. So at the end of the day, if not only in day one, but you also need to look at it and say, what if interest rates go up by, 1-2%, whatever it is, do I have that buffer to really be able to make sure that I'm going to be able to, facilitate this strategy? It's all good and well to, pay your debt off earlier, convert your debt to tax deductible, but at the end of the day, you're still increasing your debt position. Yeah. There's an asset that's behind it, but you're still increasing your debt position at the end of the day. So you need to make sure that you've got really a significant amount of, cash surplus in order to be able to make sure that there's some buffer built into this overarching strategy as well.
Yep. And speaking of that, another extension of that, we've been speaking a lot recently because of where we're at from a cash flow strategy and a banking strategy, making sure that you've got comfort around that through the discipline and the structure and the process that you've got in terms of, you know where your money's coming from, you know where your money's going, you've got discipline, there's no leakage, there's no, missing bills, there's none of that. And even further is having a clear understanding of what your emergency fund number needs to be and actually having that aside.
Yeah.
So in the event that, your income is disrupted or you get a bigger expense for that particular month, you've got liquid funds, you've got an emergency amount of money to be able to dip into in order to be able to access, because as you're taking on more debt, the risk just generally increases.
Yeah, so you need to have and you've already touched on it when it comes to the sleep test, but you need to have a tolerance to risk in order to be able to, go through this strategy. So usually one of the requirements for us when we're recommending a strategy like this to clients is you need to first have invested in the type of shares that we're taking equity out to invest in.
Yep.
So you're not going to, take out equity to invest in the share market if you've never just utilized your own funds to invest in the share market.
Yeah.
Because when you're borrowing to invest, you're increasing your opportunity for growth, but at the same time, you're also increasing your risk at the end of the day as well. So really from our end, you need to have some investment, history. You need to, have seen market movements, being comfortable with it, and understand how all of this works. Because otherwise, it can lead to, irrational decision making, and that's not what you want to do in a strategy like this.
Yeah, risk tolerance is a really big one, and the comfort around investing in something potentially new, that can be a challenge. But when you couple that at the same time with taking on more debt, I think that's critical, because these strategies, they're complex, they're not necessarily cheap to set up. There's a few moving parts because there's lending facilities and the like. So you don't want to go down this process, spend that time, money, and commit to it, and then realise that, hey, this is not the right thing for me because I don't have the tolerance for it. And there's no right or wrong answer here, but you want to make sure that you understand it and you know what you're doing from that perspective.
Yeah, and look, the other thing is you probably want to have a certainty of income as well. If you're again, taking on additional debt, you want to make sure that, your income isn't sporadic, or if it is, that you want to have a solid cash flow strategy where you are able to smooth that out, and there's buffers in place. But certainty of income is another big one. If you've got, some concerns about potentially losing your job or moving overseas or doing something like that, then it's probably not the right strategy for you. You really need to be in it for the long haul as well.
Yeah, most definitely. And look, another thing to take into consideration, and it's a requirement from our perspective, from a professional obligation point of view and from a licensing perspective, we need to make sure that a client has adequate insurances in place if something happens. You don't want to help facilitate this. You don't want to deliver advice on this strategy, and then all of a sudden there's some sort of illness or injury, you lose your ability to earn income, and all of a sudden it's like, geez, now I'm in some really hot water. So having some insurances is a requirement from our perspective when we're recommending these strategies as well too.
Yeah, absolutely. So look, it's, in summary, a really powerful strategy. It's something that kind of bridges the gap. I think we were talking in the last podcast, we're talking about, do you pay off debt? Do you invest? And you've got a strategy there that's available that, if you meet the requirements, can do absolutely both. So ridiculously powerful strategy, but it really needs to be right for your circumstances. It needs to be right, from your comfort levels. And so you need to make sure that there are some risk mitigation strategies in play if you're, embarking on something like this as well.
Yeah, and probably the last thing from my end in terms of what are the requirements, what does it look like for somebody in terms of being able to even consider and be eligible for this, you need to be open to receiving advice around this, because it's not necessarily it's not a strategy that you'll be able to deploy yourself. It's complicated. There's risk factors associated with it. So this will be a strategy that gets delivered to you in a formal advice setting. You won't be able to do this yourself. So it may sound great, but if you're not of the opinion that you wanted to go down the pathway of engaging a financial advisor and getting that advice, then it's going to be really difficult to be able to do it. So I just wanted to call that out as well too, because we talk about a lot of great ideas and stuff, but this is one that definitely needs advice, and we're obviously big advocates of receiving advice anyway, because it's not necessarily just one thing that we'd talk to a client about, but you'd have to be open to advice.
Absolutely. Bills, I think that summarizes it really well. I think that gives our listeners and our viewers a good overview of what a debt recycling strategy is, how it can be utilised, and some of the benefits and risks associated with it as well.
So shameless plug, 40 Winks if you're listening, sponsorship.
Yeah, exactly, sleep test.
And for anybody who wants to pay off their mortgage faster and met some of that criteria that we were talking about before, reach out to the team at 360 Financial. We'd be more than happy to have a chat. Thanks for joining us today, and we'll catch you on the next one.
Thanks very much. Like and subscribe. Look forward to catching you on the next podcast.
Thanks for listening today. If you have any questions on what we've talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.